Teaching Tax Flow podcast, where the goal is to empower and educate you to legally and ethically minimize taxes paid over your lifetime.
Welcome back to the Teaching Tax Flow podcast, everybody. Today, episode 95, we are going to talk about Deferred Sales Trusts. That's right, the countdown is on to episode 100 here on the podcast. But before we jump into today's topic, let's take a brief moment, as always, and thank our episode sponsor.
This podcast is brought to you by Strategic Associates. Are you a high-income earner, real estate investor, or successful entrepreneur who is frustrated by having to pay $75,000 or more of annual tax liability? If so, Strategic Associates can help. Your first step to saving thousands, if not hundreds of thousands, is to contact Roger Roundy at roger@strategicag.net or by calling 801-641-2956 and be sure to tell him TTF sent you.
Welcome back, everybody, to the Teaching Tax Flow podcast. As you've seen in the description of the episode, you've read the title, you've read the description. You've probably heard us talk about this topic maybe a couple months ago. I feel like we brought it up in something me and Chris may have been talking about. But more importantly, as I mentioned, right, we are only 5 episodes away from episode 100. That is 100 consecutive weeks of us knocking this out. Great topics, great guests, and, you know, Chris Pacchiro is usually on here with me too. So before we get into the topic, though, I do want to mention something, right? For everybody that's counting down the days to the end of the year, I hate to be the bearer of bad news, but you really don't have that long. So if you think about it, right, you got 4 months, give or take, lots of time, technically, to plan, but also lots of time to procrastinate and completely fall on your face. So that being said, I will stop being the bearer of bad news. Chris Pacchiro, welcome back to the show. Good sir, how are you doing?
I'm doing great. Thanks for having me back. I'm excited about this episode. In the real estate world, we hear a lot about DSTs, which in that context would be a Delaware statutory trust. But there's another DST, and this DST, I believe, has a much broader scope. And I'm so excited about our guest today. He's going to talk through what the other DST is. It stands for Deferred Sales Trust. It's an amazing tax planning tool that I've personally see happen with many clients. And we're going to talk through that. I'm always intrigued to bring a new tax strategy to many of our listeners. So we are, as you know, John, in Teaching Tax Flow, we believe your tax return is a verb and not a noun. So if you are getting worried that you're getting close to the end of the year, you might want to think about having a personalized tax plan put together by your tax professional. If you need help with that, just contact us and we'll help guide you in the right direction. Now, enough of that. I'm excited about our guest, Todd Jackson of Todd Jackson Law. Todd is my absolute go-to person on anything Deferred Sales Trust related. We have worked on mutual clients together. And believe it or not, it's kind of a confession here. John, get your holy water out. I didn't know what a Deferred Sales Trust was until I met Todd and I was introduced to him by a mutual client. So I'm always learning new strategies, but this is really solid. Todd is also from beautiful and historic Franklin, Tennessee, my favorite city. I'm a little biased, but that's not why we have him on the show. We have people on the show from all over the country. So Todd, welcome to the Teaching Tax Flow show, and thanks for joining us.
Of course. Hey, thanks for having me, you guys. Glad to be here. I appreciate the introduction. So before we jump into the guts, just a little bit of background. So I am I'm a tax attorney primarily, but also an M&A attorney, real estate attorney. So in other words, my phone rings when somebody is selling something at a gain. I don't get many calls if somebody's selling something at a loss, but my phone usually rings when somebody's selling something and they're facing a capital gain, and they need some planning around that. So that's kind of where I come in, and that's where common clients we've had have been facing that situation. So what I do has to do with deferral of capital gains. All right. So just to be clear, this is not a shelter. This is not an avoidance of capital gains taxes. It's a deferral. They're going to be paid. They're just going to be paid over time and later, just like many other deferrals, IRAs and 401ks, and all the other deferrals that are in the tax code. This is one more. So this is not the Al Capone school of tax evasion, right? We don't do that. We follow the rules and taxes are paid. But just like the benefit of those other deferrals, we use the same benefits because obviously being asked a simple question, would you rather pay something today or 10 years from now? Most people are going to say, well, yeah, it'd be cool to pay it a little bit later, get a little bit of a benefit for time value of money. That's what we do. So that's kind of the background. Now, this specifically of the Deferred Sales Trust is a specific way of configuring a deferral strategy. We use what's already in the tax code, and most of the time we're using installment sale treatment. We can get into what that means, but I'll just lay out the most basic way to look at an installment sale. And a whole lot of your listeners have probably done one. That's somewhere along the way. It is simply selling something and being paid later over time for that thing. Okay. So from a tax standpoint, that's a deferral because, so Chris, if I buy something from you for $1 million and you're such a nice guy, you say, tell you what, I'm going to be the bank for you because I know, Todd, you don't have any money. So you say, I'm going to be in the bank. I now own that thing, but I owe you $1 million. Okay. If the IRS showed up and said to you, hey, Chris, we understand you sold this for $1 million. Where's our money? You'd say, wait a minute. I haven't got it yet, right? I mean, I'm going to get it. And I'm going to be paid over time. And when I get that money, clearly I'm going to pay you as I receive payments. That's an installment sale, right? And that's why it's a deferral, is because if it were taxed when you sold it, you'd have no way to pay the taxes because you haven't got the money. That concept, the installment sale, has been in the tax code for going on 100 years. So just about as basic of a concept as you can get. That's the basis for how we structure what we do.
No, that's important because what we understand when we talk about tax planning and strategy is that your marginal tax rate, remember, that's the number one KPI or key performance indicator or driver when it comes to tax planning and strategy. Your marginal tax rate is not static. Your marginal tax rate is more important than your tax bracket. So that's why when we talk about being able to spread and control legally and ethically the recognition of income into different tax years, that's where there's a ton of savings. So think about this. Todd mentioned tax deferral. Let me paint a picture. Let's say you have $1 million taxable event, and if it was all in 1 year, you'd be in a 30% marginal tax rate. It would cost you $300,000 of tax. If by spreading it over time, you can take that marginal tax rate down to 15%, that means it's $150,000 worth of tax. You've saved yourself $150,000 worth of tax, yet you have paid tax on that $1 million legally and ethically, but you've been able to spread it out into certain marginal tax rate years that you might have a lower number. Or, you might have another tax event that can offset the taxable income. That's why tax strategies don't happen in a bubble. They work together. So if you're a real estate investor and you're having cost segregation studies done, or if you're starting a business and you have business losses in 1 year for a business that's going through growth, those are better years when you're in lower marginal tax rate years to absorb the taxable income. And that's what the power of this isn't some hocus pocus. This is deferring the gain into look, think about this, Todd and John. If I said, I'm going to fly today from here to Orlando, Florida, I have to look, and I can only fly on Southwest, which has I'm just going to use Southwest. Oh, Southwest, you should be a sponsor of this podcast if you're listening. I only can fly the times Southwest wants me to fly. And those come with opportunity costs. They could be financial They could be, I don't want to wake up at 4 a.m, or I don't want to fly at 10 p.m. when my flight could easily get delayed. What if I got to pick when I get to fly? That's what's happening. And hopefully, I don't know if anyone's ever, that just hit me that is a way to look at recognizing income.
And Todd, I actually have a question for you too, and I think I know the answer to this, but I almost guarantee some of our listeners have probably begun asking themselves this question as we were talking. So I love your description of a DST and how it's an installment sale. So that way, the way you describe it and kind of walk through makes a ton of sense. So I think that's pretty clear. But those that have also listened to many of our podcasts, we talk about 1031s, I'd say probably 10% of our episodes. How does this differ? Is there any similarities to a 1031 exchange?
Of course. So, and for background, I'm actually a 1031 qualified intermediary. I've got a 1031 company, and I do those every day for people. So I have firsthand experience with how the two of them differ, right? And so here are some of the main differences. 1031 has some restrictions as far as some timing requirements. So I'm doing a 1031 after I sell a piece of real estate. Number one, I've got 45 days to identify what I'm going to buy next as a replacement. All right, that's just a standard time frame. Now, downside to that generally is I'm not smart enough to sell high in a market and buy low within 45 days in the same market. So that's really one of the main challenges to a 1031. Certainly isn't an obstacle. People do them all the time, and that's number one. Number two is you have to purchase whatever you identify within 180 days of when you sell. So your readers probably understand those basics. Now, getting into a little bit more of the nitty gritty, another requirement of a 1031 is that you've got to replace any debt that you paid in that sale. I'll give you an example. I get a call from somebody that says, "Hey, I'm selling real estate for $10 million, and I've got $5 million in debt, and my tax basis is $5 million. So in other words, I'm going to get proceeds of $5 million, and that's my gain." And they say, "I want you to do a 1031 for me so I can invest that $5 million. And I have to give them the bad news that no, we're not going to do that. If you do a 1031, you're buying something for $10 million. You're using the $5 million in cash, and you're also going to replace that debt with new debt, right, of $5 million. And they say, "Wait a minute, I'm paying off debt that has a 3.5% interest rate. There's no way I'm replacing that with 9% new money." And I say, "Well, then you're not going to do a 1031. And they say, "Well, I love this price I'm getting, right? What else can I do?" Well, this is one of the times when the Deferred Sales Trust is an alternative to a 1031, because the requirements that you replace debt, that's a 1031 requirement. And since we operate ours in Section 453, which is installment sale treatment, there's no such requirement that you replace debt. So they can use truly the gain for investing going forward and not have to replace that debt. So that's one of the main differences. Another one that comes up a lot that you've probably talked to your listeners about is somebody is either coming out of an asset that doesn't qualify for 1031, or they want to go into an asset that doesn't qualify. The main one that comes up consistently is like a syndication, right? Somebody says, "Listen, I'm going to sell this piece of real estate and I want to buy into the syndication with this group." Well, the problem is what they're buying is an LLC interest, not real estate, doesn't qualify, right? And so that, again, that's another 1031 requirement that keeps them from doing it. Only is that a restriction in 1031. With our trust structure, there is no such restriction that the trust can invest in that syndication without any obstacle because we're not in 1031, right? So we see that a lot. So that's just a couple of the ways that they differ. Now, to be clear, 1031s are awesome. I do them every day. It's been a part of my practice for 30 years, right? But when they work, right? What I do see, though, that's kind of unfortunate is people will buy something in a 1031 they don't want. Absolutely don't want this because they feel like they have to, or these dire consequences are going to happen. That's when this trust structure is a good option because you're not forced to make a bad decision. Because again, we don't have those time restrictions in this, right? Somebody might tell me, "Hey, yeah, I may or may not want to buy my real estate, but I want to sit on the sidelines for a year or two." Well, 1031 is not an option for that with those time constraints. So We just got to phrase it up to where it's not quite as strict as far as this timing goes.
Right, because ultimately the DST, the Deferred Sales Trust, it has flexibility. It has a lot more flexibility. But I want to talk about, Todd, is you mentioned when your phone rings when a transaction occurs. If someone, who's a good candidate for this and when should they contact you? Because there are some similarities with the 1031 exchange as far as timing. I mean, I believe you have to have the trust instruments started before the sale occurs, but I'm sure you could speak to that a lot better than I can.
Of course. Yeah. So just, by way of background on the structure, absolutely has to be done before the sale, right? Because what we do, just like a 1031, as far as the purpose of it, it's to avoid actual receipt of money, right? There's nothing we can do to defer gains if you've received the money. And we also need to avoid constructive receipt of the money. So that's a term the IRS uses. That means, you may not actually have the money in your account, but there's no obstacles from getting it. And a good example is somebody calls me and they say, hey, I want to defer gains on my sale. And I say, okay, when are you closing? They say, well, I closed yesterday, but I don't have the money yet. And I said, well, where is it? Well, it's in the attorney's trust account. And I says, well, what are the conditions to you getting that? They say, well, they just need my wiring instructions. Well, that's constructive receipt. That's taxable. There's not anything I can do about that. So what we do then is we get this in place ahead of all of that to where none of that has happened yet. And we get the structure in place because what we need to happen is we create the installment sale, not with the buyer of that asset, right? Because you can always do that. So Chris, if you're selling a piece of real estate, you can sell that to the buyer. You can agree to be the bank and finance it, right? Well, the downsides to that are, number one, what if they don't pay you, right? Then you have to take that asset back, right? Because you have to foreclose on it. But if by then they've destroyed it to where it's not worth anything near what you're owed, that's the downside, right? So we create the installment sale ahead of all of that between a new trust that I established and that seller. So the installment sale is between the trust, which is an unrelated party to them, as just not, there's no common ownership, anything like that, between the seller and his trust. And that asset now is owned by the trust. The trust is the seller to the buyer, right? So that's done, and the installment sale is in place before that sale happens. And now the trust is the receiver of the funds from that sale. And those funds are invested by the trust to service that note that's payable with interest and everything else that's negotiated to that seller. And then from there is what Chris already talked about, is you're taking that gain, instead of having it all hit at once, it's hitting over time on a schedule that you arrange, right? So yes, absolutely has to be in place ahead of all of that.
So obviously I've talked about flexibility. Another thing is control. That's, I think, Todd, when we hear people in the teaching tax law community, they're concerned about, okay, I put this money into the trust. That's the negative of the 1031 exchange. A lot of times, if you put your money into a syndication, you don't have control of that asset. Can you talk a little bit about what are some of the things that, so if I created a deferred sales trust for myself, and let's say I sold, my whatever, I found a baseball card or some collectible or something like that, or I have an asset that I'm selling and I put it, I create this trust and I have a big capital gain that I defer. The cash goes into the trust. Can I still invest that into different, stocks, bonds, mutual funds? What are some of the, am I the trustee of the trust or the beneficiary? How does that, what's my role then is probably the better question.
Okay. So that's a great question. And we're going to go back to what we just talked about a minute ago, which is constructive receipt. So we have to create this and maintain it in a way that prevents you from having constructive receipt to where that triggers all the gains. And what that means then is you can't be the trustee. You can't be the owner of it / beneficiary, right? All of those things. The relationship, this is the central to the whole thing. The relationship between the trust and you as the seller is that of an installment sale, which is borrower, trust, lender, Chris, right? Borrower, lender. Because we have to maintain the fact that you're totally an unrelated party to the trust. For example, if I've got a house, right, and my lender on that house is Bank of America, right? That's a borrower-lender relationship. Well, I'm not related to Bank of America. I've got nothing to do with them other than I owe them money, right? That's what we do here because we have to have it to where you're not related, because if you're a related party, the deferral cannot work, right? Now, but to your specific question about control, you are a secured creditor, right? Just like Bank of America is on my house, which means that you've got a security interest on everything that's in this trust, which means trustee, financial advisor, anybody that's making investments, they have to get your approval before anything's done because, again, you're the secured creditor. They can't just do what they want because you've got a lien, a security interest. So that gives you creditor control, right, as opposed to actual possessive control. This is in your own account. It's going to feel very much like the same thing, but that's what is required to keep the relationship the way it needs to be.
And then the trust could invest in, I mean, what do the trust typically have a brokerage account or a savings account, or what are typically the things that they park their money into?
So there'll be a brokerage account. So obviously we want the trust to be, this is a preservation strategy, right? You want the money to be there tomorrow. So usually Schwab, Fidelity, the largest clearinghouses, brokerage account is where the money is managed, okay? Now, what the trust can invest in, there's not any restriction. It can invest in anything. That's never the conversation, okay? 100% of the conversation is what it should invest in. For example, Chris says, hey, I want to put all my money in Bitcoin, right? Well, can he do that? Well, yeah, the trust can do that. Should it do that? Absolutely not, right? So that's what I'm saying is it can invest in anything, but it's going to be geared around what it should invest in based on what's, fits the risk tolerance, make sure it's a reasonable investment, that it's, it's going to preserve that asset, but at the same time produce some income because it has to have the income to pay the interest on that installment note. So what's invested in is tied more directly to the risk tolerance, what's the creditor is going to allow to be invested in, right? So if Chris is super conservative, right, maybe it goes into treasuries, which are paying really well right now, right? If he says, hey, that's great, 5.5 is cool, but if I want to get 7, 8, what do we need to do? And the financial advisor is going to say, well, you got to take on some risk to go from treasury, no risk essentially, to, a little higher than that. You need to take on some level of risk.
All right. So we talked about timing when you start the trust. So if you're listening to this and you have an imminent large capital gain event that might occur, that's the time to start thinking about a deferred sales trust. We also talked about what the trust can do as far as operationally, from a 30,000 foot view level, what it can invest in. We know that the trust is meant to preserve the money and grow the assets or the money in the trust to pay back the loan from the person that started the trust. But Todd, can you talk a little bit about on the back end? So how does someone get the money out of the trust and ultimately recognize that income over a certain amount of years? And what's the typical lifespan of such a trust?
Of course. So the promissory note for the installment sale drives all of that, right? It has the terms for how long, what kind of payment structure, interest rate, all of that. So it's a contract. So it's all driven by that document, right? And that's how it goes through for its scheduled the structure, right? Usually that's going to start out with say 10 years, right? On a note, gives us time to kind of have spread it out, have a payment structure. But yeah, so that document controls how that's paid out.
And is there a maximum amount that the note can be entered into?
Yeah, so it's got to be, the IRS says it's got to be commercially reasonable, right? Or something you could get at a bank, similar type of loan. So we can't do a 20 or a 30 year. So 10 years is pretty standard. They will do.
Okay. So for someone listening, if you've got any, like I said, a long capital gain that's coming through, you're interested in doing some tax planning and potentially spreading that gain up to give or take at least 10 years, this is something that you want to consider. And Todd, to wrap things up, who's going to be the best avatar for you? In other words, at what point does this might make sense when you associate the tax mitigation and the cost? What type of capital gain should be, obviously if you sold your Apple stock for a $3,000 gain, this is probably not the best structure for you. But where does it start making sense from a tax perspective?
Yeah, I usually say if you've got a capital gain that exceeds $500,000, right? That's starting to get into the area to where this could make some sense, right? Anything less than that, the structure is probably a little bit cumbersome for smaller gains to where they're really not going to see as big a benefit. So and there's really no real number, right? But that's kind of just a general area. It's kind of arbitrary to go by.
Gotcha.
Rule of thumb.
Well, I do have a couple fun questions to end this. Obviously, we're going to put all your information in the show notes. If someone, once you listen to this, if you're interested in that, we're going to give you the opportunity to reach out to Todd. And also, if you're in our Defeating Taxes private Facebook group or following us on any social medias, reach out to John, myself, or Todd. Like I said, all that information will be in the show notes, and we're happy to make sure you get put in the right direction. But Todd, I've got a few fun questions to wrap things up, non-tax related. All right. And the first one is, tell me one thing that might surprise our listeners about you that someone might not know.
I'm kind of, I guess I've got a career ADHD. So I'm going to run down a real quick list. So in addition to being an attorney, MBA, 1031 QI, I'm a real estate agent. I'm a title insurance licensed agent. I'm an M&A advisor. So I kind of can't help but wear a bunch of hats at the same time. But there's some reason for that is because it's so hard to separate all of those things because they're all interconnected on most transactions.
Well, I think it's a good comprehensive approach.
So I call it ADHD for our career.
Nice. What would be an ideal weekend for you?
Wow. All right. So probably a nice dinner with my wife, followed by 36 holes on Saturday. Playing golf. I get in trouble if I just say the golf part.
I know. Yeah. Well, our wives don't listen to our podcast, so we put them throw them under the bus all the time. Unless we tell them not to listen to it, and then they somehow will listen to that one. That's just how it works for John and I. Do you have a team? What's your favorite sports team?
Oh, wow. I've always been a San Antonio Spurs fan. I'm a big basketball fan. And Tim Duncan started at Wake Forest, where I was in law school and MBA school. And so I got a chance to meet him as I was going out. He was coming in. Was an immediate fan, super nice guy. And 5 rings later, now retired, I kind of became a permanent Spurs fan. So if I had to pick one, that's it.
I didn't know you're a Demon Deacon. That's pretty cool. Last question. It's a fun one. What's your favorite cereal?
Well, it's got to be Peanut Butter Crunch, Captain Crunch, because anybody that doesn't agree with that has mental problems of some sort.
Oh, we go through peanut butter like water in our house.
There you
go. And all peanut butter and chocolate related cereals, but I do like myself some Golden Grahams once in a while.
Of course.
Awesome, gentlemen. Awesome. Well, Todd, we appreciate you joining us on this one for sure. Chris, thank you for obviously getting back on your own show. And Todd, actually, I have a bunch more questions on these that I'm going to have to hold out until next time when we have you back. Maybe dive into the weeds a little bit on this if you're so inclined to join us back here.
Glad to come back anytime.
So, we're going to hold you to it. And on that note, we will see everybody back here again on the Teaching Tax Flow podcast next week, about the same time of day-ish. different topic though. So we will see everybody, or you should hear us, I should say, very soon.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.